How Smart Money Thinks About Crypto, a guide for navigating the digital frontier. Let's be honest. The word crypto probably conjures up a few distinct images for you. Maybe it's that coworker who wouldn't shut up about Dogecoin in 2021. Maybe it's headlines screaming about a billionaire's rug pull or a catastrophic exchange collapse. It's a world that seems equal parts lottery ticket, techno-utopian dream, and Wild West scam. So, when we hear the phrase smart money, it feels like it doesn't belong in the same sentence. Smart money is Warren Buffett buying Coca-Cola in 1988. It's pension funds with 100-year horizons. It's calm, measured, and boring. Crypto is not that. But here's the secret. While the noise is dominated by get-rich-quick schemers and panic-driven traders, a different class of investor has been quietly building in this space for years. They aren't gamblers. They are venture capitalists, hedge fund analysts, family offices, and institutional allocators. They think differently. They move differently. And understanding their mindset isn't about getting a hot tip. It's about learning a new framework for evaluating one of the most transformative, misunderstood assets of our time. Forget the charts with lasers on them for a minute. Let's talk about how smart money actually thinks about crypto. Part 1, the foundation. It's not an asset class. It's a paradigm shift. The first and most critical divergence between smart money and the crowd is the foundational belief. The crowd sees crypto as a trade. It's a thing you buy low and sell high, an electronic token that magically goes up. The narrative is simple. Number go up. Smart money, particularly the early and successful allocators, sees something broader. They see crypto as a new architectural layer for the internet and finance. They use terms like decentralized protocols, trust-minimized systems, and programmable money. This isn't jargon to sound smart. It's the core of the thesis. Think of it this way. Investing in Amazon in 1997 wasn't a bet on book prices going up. It was a bet on e-commerce restructuring global retail, on cloud infrastructure AWS, on a new paradigm of consumption. The book price was merely the first clunky expression of that deeper shift. Similarly, Bitcoin isn't just digital gold to them. It's the first viable, global, decentralized, mutable, and scarce digital asset. A new primitive for storing value outside the traditional financial system. Ethereum isn't just a coin for gas fees. It's a globally accessible, neutral settlement layer where you can build financial applications, DeFi, digital identities, and ownership records, NFTs as deeds, without a central intermediary. The takeaway for you: before you buy a single Satoshi, the smallest unit of Bitcoin, ask yourself, what am I actually betting on? Am I just betting that more people will FOMO in after me, a greater fool theory? Or am I allocating capital to a technological and socioeconomic shift I believe is merit? Your entire psychological framework changes with the latter. It turns a speculative punt into a strategic allocation. Part 2, the three-layer cake, where value actually accumulates. Smart money breaks the ecosystem into layers, each with different risk/return profiles, just like they'd analyze the tech stack of the traditional internet, infrastructure, platforms, applications. Layer 1. The protocols, the foundation. These are the blockchains themselves, Bitcoin, Ethereum, Solana, Avalanche, etc. Investing here is a bet on the ecosystem. It's like buying stock in the operating system Windows, iOS. The value thesis is that developers and users will flock here, and the native token BTC ETH will capture that value through security fees, gas, staking, or simply as a base currency. Smart money evaluates these on technical merits, scalability, security, decentralization, developer activity, community strength, and governance models. They're looking for robust fundamentals, not just hype. Layer 2, the primitives and applications, the services, build on top of the protocols. This is DeFi, Uniswap, Aave, infrastructure services, Chainlink for data, and even certain NFTs with utility. Investing here is a bet on a specific use case, winning within a thriving ecosystem. It's like investing in PayPal during the rise of the internet. Smart money dives into tokenomics. How does the token actually capture the value of the service? Revenue generation, real fees paid to holders, competitive moats, and the quality of the team. They ask, is this token a glorified coupon, or does it function like equity in the network? Layer 3, the wrapping and access layer, the pipes. This is the bridge to the traditional world. Exchanges, Coinbase, custody solutions, ETFs, and analytics firms. Investing here is often a bet on mass adoption. It's less about the crypto thesis and more about a traditional business model enabled by crypto. It's picking the shovel sellers during a gold rush. The analysis looks more like standard equity analysis: management, regulatory positioning, market share, and financials. The takeaway for you: don't just think, I'm buying crypto. Be specific. What layer am I investing in? And what is the specific value proposition? A layer 1 bet is a macro bet on a new digital nation. A DeFi token bet is a bet on a specific financial service outcompeting its peers. Allocate accordingly. Part 3. The process, due diligence beyond the memes. This is where the rubber meets the road. While the crowd is scrolling Telegram groups for alpha, smart money is doing real work. 1. On-chain analysis. They don't just look at price. They look at blockchain data itself. How many unique active addresses are there? Are large holders whales accumulating or distributing? What's the flow of funds into and out of exchanges? This is like having access to the Fed's ledger or the real-time financials of a public company. Tools like Glassnode and Nansen are their Bloomberg terminals. 2. Governance and community. They lurk in Discord servers and governance forums. They're not looking for moon emojis. They're assessing, is decision-making rational? Is the developer community engaged and reputable? Is there a coherent roadmap? A project with a toxic or passive community is a red flag. 3. Tokenomics deep dive. They mercilessly analyze the token supply. What's the inflation schedule? How much is held by insiders? And what are the vesting schedules to avoid sudden dumps? Is the token necessary for the network's function, or is it an afterthought? They model out potential supply and demand scenarios. For counterparty risk assessment, the collapse of FTX was a stark lesson. Smart money obsesses over counterparty risk. Where are the assets held? Is it on a reputable, audited exchange, or better yet, in self-custody? Who are the other players in the ecosystem? They assume many actors are incompetent or malicious. 5. macro and regulatory mapping. They understand crypto doesn't exist in a vacuum. It trades in a global macro context, liquidity, interest rates. They also have a keen eye on regulatory developments, not as a binary good/bad, but as a landscape to navigate. They ask, which jurisdictions are creating clear rules? Which projects are proactively engaging with regulators? The takeaway for you: you don't need a PhD to adopt this mindset. Start small. Before your next investment, spend 3 hours doing this. Read the project official docs, not just a website. Check its GitHub activity. Look at its token unlock schedule on a site like Token Unlocks. Read 10 pages of its governance forum. You'll instantly filter out 95% of garbage. Part 4. The psychology, patience, cycles, and conviction. This might be the biggest difference. The crowd psychology is driven by fear and greed on a daily basis. Smart money psychology is built on a different set of principles. Time horizon. They think in multi-year cycles and epochs, not quarterly earnings. They understand crypto's 4-year, having cycles and the boom/bust nature of technological adoption. Remember the dot-com bust. They enter with a plan measured in years, not days. Volatility is a feature, not a bug. They don't just tolerate 80% drawdowns. They expect them and, in some cases, plan for them. This volatility is the price of admission for asymmetric returns. Their risk management, position sizing, diversification across layers, is built to withstand this. The discipline of conviction. They build a thesis and stick to it through gut-wrenching volatility, unless the fundamental thesis breaks. The crowd sells the bottom out of panic. Smart money often uses those moments to rebalance or cautiously add to positions they deeply understand. They separate price action from fundamental progress. Intellectual humility. The smartest players know how much they don't know. The space moves fast. They maintain a strong opinions, weakly held mindset. They constantly stress test their own assumptions and are willing to admit when they're wrong. The takeaway for you: write down your thesis for every investment. I am buying X because I believe Y will happen over a Z-year time frame. When the price crashes 50%, don't look at the chart. Reread your thesis. Is the reason you bought it still true? If yes, hold or buy more. If no, sell. This simple act divorces you from emotional reactivity. Part 5. Practical advice. How to start thinking like smart money. You're not a billion-dollar fund, but you can adopt the principles. 1. Start with a macro. Allocate with conviction. Decide what percent of your total net worth you are willing to potentially lose in this asset class. 1%? 5%? This is your strategic allocation. Commit to it mentally. This is not play money. It's a serious, size-appropriately bet on innovation. 2. Build a core satellite portfolio. Core: 60 to 70% your high conviction, foundational bets. This is likely Bitcoin and Ethereum. For smart money, these are the least risky assets in a very risky field. They're the indices of crypto. Satellite: 30 to 40% your higher risk, higher reward bets. A promising layer 1. A few to 5 blue chips. A small, speculative allocation to a nascent trend like Depend or AIX crypto. This is where you apply your due diligence. 3. Master self-custody. Smart money minimizes trust. Learn to use a hardware wallet, ledger, treasure. Holding your own assets is the single most empowering and secure thing you can do. Exchanges are for trading, not for storage. For dollar cost average, you say, in take profits out. Have a plan to buy consistently over time, regardless of price. This removes emotion. Similarly, have a plan to take profits. Smart money never gets rich on paper only. They systematically sell portions of winning positions to return initial capital and recycle gains. They take chips off the table. 5. Focus on learning, not just earning. Dedicate time each week to learn. Listen to podcasts from builders, not traders. Read research reports from firms like CoinShares or Electric Capital. The knowledge compound interest is more valuable than any single trade. 6. Ignore the noise, tune into signal. Delete price alert apps. Mute influencers on X. Curate a list of thoughtful builders and analysts. Your goal is to understand the technology and adoption metrics, not predict next week's price. The final word, it's about sovereignty. At its deepest level, smart money's interest in crypto is a bet on a shift in power from centralized intermediaries, banks, big tech platforms, governments, to decentralized networks and individual sovereignty. It's a bet on open, transparent, and programmable systems over closed, opaque, and rigid ones. This doesn't mean every project will succeed. In fact, most will fail spectacularly. The dot-com bubble wiped out trillions, but it also laid the fiber optic backbone for the modern world and birthed Amazon, Google, and Netflix. Your job as an investor is not to find the one coin that will moonshot. That's gambling. Your job is to make a sober assessment that this paradigm shift is real, allocate capital you can afford to lose to it, place your bets across the infrastructure and applications you believe have the best chance of enduring, and manage that portfolio with the discipline of a marathon runner, not a slot machine junkie. The crowd will continue to chase the hype. Let them. You can choose to think, invest, and build like the smart money. It's quieter, more rational, and in the long run, far more powerful. The future isn't just digital. It's cryptographic. Understanding how to navigate that world with eyes wide open is perhaps the most valuable investment you can make. Part 6. The nuanced realities, where theory meets the chain. Understanding layers and due diligence is foundational, but the devil is in the details. Here's how smart money grapples with the unique complexities of this space. The interplay of narratives and fundamentals. In traditional markets, fundamentals often eventually drive price. In crypto, especially in its adolescent phase, narratives drive liquidity, which then tests fundamentals. A narrative like the modular blockchain thesis or real-world asset RWA tokenization can flood a sector with capital and attention. Smart money distinguishes between a narrative with substance and pure hype. They ask, is this narrative revealing a genuine unmet need in the ecosystem's development? Is it attracting smart developers and real capital, or just influencers and speculators? They might ride a narrative wave for a time, but their exit is determined by whether the projects can turn narrative traction into fundamental, sustainable utility once the hype subsides. The team versus the token. In venture capital, betting on a stellar team is paramount. In crypto, with its ethos of decentralization and anonymity, This gets complicated. Smart money evaluates on a spectrum. Doxed, all-star team, a project like Avalanche or Polygon, with known credential founders, offers traditional reassurance but also centralization risk. Pseudonymous, proven builders, many of DeFi's most revered figures, like Andrei Krony of Year in Finance, were initially pseudonymous but built undeniable, functional, and valuable code. Here, the proof is in the product itself. Fully anonymous/community-driven. Like Bitcoin, where the team is a diffuse group of core maintainers. Here, evaluation shifts entirely to the robustness of the protocol, the fairness of its launch, and the health of its contributor community. Smart money is comfortable across the spectrum but adjusts its risk assessment accordingly. They are deeply skeptical of anonymous teams asking for money before delivering functional code. The liquidity trap. You can be right about a project's fundamentals and still get slaughtered. Why? Illiquidity. A small cap gem you've brilliantly identified might have a market cap of $50 million, but the real liquidity, the amount you can buy or sell without moving the price 30%, might be less than $1 million. Smart money always assesses liquidity depth on decentralized exchanges, DEXs, and the order books on centralized exchanges. They scale their position size to a fraction of the available liquidity. Getting in is easy. Getting out at your target price is the real challenge. Part 7. The Advanced Toolkit Beyond Basic Charts. While retail stares at Relative Strength Index, RSI, and Moving Average Convergence Divergence, MACD, on TradingView, smart money employs a more sophisticated suite of indicators. MVRV, market value to realized value ratio. This compares the current market cap to the aggregate cost basis of all coins. A high MVRV suggests holders are sitting on large profits and may be prone to sell. A low or negative MVRV suggests the market is underwater, which can indicate capitulation and a potential bottom. It's a macro, on-chain sentiment indicator. Network value to transactions, NVT ratio. Think of it as the crypto price-to-sales ratio. A high NVT suggests the network's valuation is outpacing its economic throughput, transaction volume, signaling potential overvaluation. It helps distinguish between price driven by utility versus pure speculation. Futures funding rates. In perpetual swap markets, funding rates tell you whether longs or shorts are paying fees to the other side. Consistently high positive funding rates indicate excessive leverage from bullish traders, often a contrarian signal of a crowded trade and a potential flush-out, sharp drop coming. Stablecoin supply and flows. The ammunition for crypto rallies is stablecoins, USDC, USDT. Tracking the aggregate supply of stables on exchanges and their net inflows/outflows gives a sense of buying power waiting on the sidelines or being withdrawn for safety. The takeaway for you: you don't need to become a quant, but familiarizing yourself with 2 to 3 of these on-chain metrics, Glassnode's weekly newsletter, is a great start. We'll give you a 10,000-foot view of market cycles and sentiment that price charts alone can't provide. Part 8. The regulatory maze, not a wall, but a labyrinth. The crowd sees regulation as a binary threat. If the SEC sues someone, sell everything. Smart money sees it as a complex, evolving landscape to be navigated, and indeed, a source of alpha. Geographic arbitrage. They watch for regulatory clarity, not just crackdowns. A jurisdiction like Singapore, the UAE, or Switzerland crafting clear rules for digital assets is seen as a massive opportunity. They ask, Where will talent and capital migrate to? Which projects are positioning themselves in these green zones? The institutional on-ramp thesis. Smart money viewed the launch of Bitcoin ETFs not as a sell-the-news event, but as the beginning of a multi-decade structural flow of institutional capital. They understand that for giant pension funds and endowments to allocate even 1%, they need regulated, familiar vehicles. The ETF was the final piece of plumbing. Their bet shifts from if institutions come to how much and how fast. Project-specific risk assessment. They dissect legal documents. Is a token likely to be deemed a security by the Howey test? Projects with clear utility, decentralized governance, and no promises of profit might navigate this better. They see regulatory action not as a blanket negative, but as a force that will separate the robust, compliant protocols from the fly-by-night schemes, ultimately strengthening the ecosystem. Part 9. The mindset of a builder investor. The most sophisticated crypto investors share a trait. They think like builders, not just capital allocators. They often use the products. They don't just hold ETH. They stake it or use it as collateral to borrow on Aave or provide liquidity on a DX with careful attention to impermanent loss. This first-hand experience is invaluable due diligence. You understand the user experience, the friction points, and where the real value is being captured. Participate in governance. Holding governance tokens isn't just a financial position. It's a civic responsibility in a digital network. Smart money votes on proposals, debates in forums, and assesses the political dynamics of a protocol. A dysfunctional governance process is a fatal flaw. Have a network in the ecosystem. They talk to developers, other fund managers, and even skeptics. This isn't about getting insider tips. It's about sensing shifts in sentiment, understanding technical roadblocks, and identifying emerging talent. The best information flows through human networks long before it hits a research report. Final continuation. Your path forward, the long game. Adopting this mindset is a journey, not a destination. The technology will evolve. New narratives will emerge and die. Regulations will shift. Through it all, the principles of smart money thinking will remain your anchor. Embrace the learning curve. Your first foray into self-custody will be nerve-wracking. Sending a test transaction will feel silly but necessary. Reading a technical white paper will be daunting. This is normal. Each step builds competence and, more importantly, sovereignty over your assets, your understanding, and your decisions. Process over outcome. In a volatile market where luck can masquerade as skill in the short term, the only thing you can control is your process. Your process is your due diligence checklist, your risk management rules, e.g., no single altcoin position greater than 5% of my crypto allocation. Your DCA schedule, your profit-taking plan. Judge yourself on the rigor of your process, not the daily fluctuation of your portfolio. The ultimate goal, asymmetric exposure. This is the core of it all. Smart money uses their framework to seek asymmetric bets, where the potential upside is multiples of the potential downside. They achieve this through 1. Early identification. Getting in before a narrative is mainstream requires deep learning. 2. Conviction sizing. Putting meaningful weight behind their highest probability theses. 3. Ruthless risk limits, ensuring that no single failed bet can cripple them. For you, this might mean that 90% of your crypto portfolio achieves modest returns, tracking the broader shift, while a 10% allocation through diligent research and strong conviction, has the potential to return multiples on the entire portfolio. That is the power of the space. The crypto landscape is being built in real time. The crowd will chase mirages and be washed away by volatility. But those who think like smart money, with patience, rigor, and a focus on foundational shifts, will not just be passive investors. They will be active participants in shaping a new economic paradigm. They understand that the greatest reward isn't just in the gains, but in profound understanding of a system that is redefining trust, value, and ownership itself. Start today, not with a trade, but with a commitment to learn one new thing. Read the Bitcoin white paper. Set up a MetaMask wallet. Explore a DAO's governance forum. The first step in thinking like smart money is to move from spectator to participant. The rest is a continual, challenging, and extraordinary journey.